Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS. One of the big events this week is the Fed meeting on Wednesday. Because it's so important, I'd like to discuss it in some detail today. Now, the market no longer expects a hike in rates at this meeting. In fact, the market thinks that one rate hike by the end of the year is only a 50-50 proposition. Now, there are several reasons why I think a hike's unlikely at this meeting. First off, the economic indicators recently have been weaker than expected. The fact that the U.S. Economic Indicator Surprise Index is now negative shows that more indicators have been surprising on the downside recently than on the upside. In particular, the labor market indicators have been disappointing. The Fed's Labor Market Conditions Index has fallen 7 out of the last 10 months. That's important because the labor market is one of the Fed's key responsibilities. Now, at the last meeting in July, the committee was split pretty much in half. The weak data since then probably haven't been enough to tip the balance. The 12-member FOMC hasn't changed policy with four dissenting votes since 1980, nor with 2 dissenting Fed governors since 1993. Now, they might not hike now, but given how many FOMC members have argued in favor of doing so sometime, I think they're unlikely to rule out a rate hike in December either. The focus then will be on the forecasts that they issue at this meeting, and in particular, the closely watched dot plot, which gives the FOMC members predictions for where they expect the Fed funds rate to be in the future. The forecasts will be extended to 2019 at this meeting. They may use this extension to lower their expectations for rates in 2017 and 2018 so that they end up with the same terminal level of rates, but just take an extra year to get there. In other words, they would forecast a slower, more gradual pace of tightening. In that case, I'd expect the dollar to weaken. The main beneficiaries should be the high beta currencies, such as the New Zealand dollar, the Australian dollar, and the Swedish krona, and also emerging market currencies. Lower rates should be good for global economic activity, and therefore good for the high beta currencies. Now, the Kiwi and the Aussie are the G10 currencies with the highest interest rates, so when it looks like U.S. interest rates are going to stay lower for longer than it was expected, these higher interest rates become more attractive. And many emerging market currencies were threatened by higher U.S. interest rates, so again, if U.S. rates are going to be lower for longer, emerging market currencies may be more attractive to investors. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.